A new report contradicting the notion that the Chinese economy is on the verge of collapse. We've heard a lot about this recently, but this is the other side of it. China Beige book CEO Leland Miller joins us this morning. Leland, there are so many reports, as you've seen, about China's sort of imminent collapse, Evergrande. We've gone through so many different sort of headlines, even over the last week, about sort of a true slowdown taking place in China. You say that that notion is misplaced.
Well, it is misplaced. Markets did not get the recovery they wanted the first half of 2023. And because markets are bipolar on China, everything is either great or it's terrible. So now we're in the terrible phase. And we've been dealing with this, 3-4 months of people speculating that China's economy could be on the brink of collapse. The shadow banks are wobbling. Property sector weakness is sharp. Confidence is very, very low. And so there people are very justified in being a little bit gloomy on prospects for the economy. But sequentially, it has been improving in 2023. Everything except property is better than 2022. So you're seeing a recovery. It's just not the recovery that everybody was expecting.
Okay, I'm reading a headline. This is from Business Insider this morning. It's official. The era of China's global dominance is over. You buy it or not?
Well, they quote me a bunch of times in that article, so I buy some of it. But look, the idea that China is going to be this strong economic engine at high levels of growth, no, that's over. The idea that China is going away or that it's going to collapse or it's going to see a Lehman movement, that's also incorrect. So the idea is that people are too bearish cyclically on China. They're seeing the economy come apart. They think that the government doesn't have a plan. There is a plan, but people should remain pretty bearish structurally. They're too bullish structurally. So this is not China going away, but it's also the era of China promoting high levels of growth. Going forward, that era is over.
Okay, so let's say that part of it is over. How does an investor that's outside of the United States, likely somebody watching this broadcast now, think about China? And then also, let's talk about how this relates to geopolitics and their power, given all of the different battles, wars, skirmishes, and strange bedfellows that have taken place over the last decade or more on the basis that China was going to keep growing to the heavens.
Yeah, look, those two things are very much interrelated. China investing used to be, to some degree, set it and forget it, at least for the big tech companies. You invested in Baba, you invested in JD, you invested in Tencent, you invested in Meituan, and then every quarter, the Chinese government provided support, ring-fenced this economy, and things went up. And that changed a handful of years ago, and we're not going back. And if you add on to that the fact that supply chains are being pulled out of China because people are worried about things like COVID zero shutdowns, they're worried about geopolitics, they're worried about trade wars, they're worried about rising export controls. This has made it more and more difficult to invest in China. And China hasn't made it particularly easy to for foreign business to operate on the ground. So these combination of factors don't mean you can't invest in China. It just means the days of investing the way folks used to, those are over. You got to be very sophisticated now.
So help us get sophisticated. If you were going to invest in China today, how would you do it? Where would you do it? And layer onto this another issue, which is that at least in the United States, there is an overhang or question not about whether the Chinese government is going to crack down on business in China, but whether actually the American government is going to crack down on investors investing in China.
Well, that's going to be looming over us. So look, if you're investing in China, you should be producing for Chinese consumers. The idea that you're going to be mixing these supply chains in a very haphazard way, the way we've seen the past 2 decades, that's gotten increasingly dangerous because of the geopolitical risk, because of the export control risk, and other things. So if you're producing in China for China, that's a positive step. If you're producing something the government wants or the government needs, services for the elderly, if you're producing some sort of technology that hasn't been banned yet, something the government wants to have you there for, then you're in a better position than if you're trying to sit on the ground competing with Chinese firms. This is what's happened to Wall Street. They've gone in and they thought that, hey, we're going to conquer this financial landscape. Beijing wants those firms there only as long as it needs them, and then it's going to discard them.
So what businesses do you put that category in? There's a lot of financial services companies that think that they're doing business in China. How do you think about financial services in China, U.S. firms that are trying to be there?
Well, the idea behind financial firms, going hard into China was that there's not that many ways for the Chinese households to save money for the long term. And so there's a sophistication on Wall Street that was going to be shared with China, was going to be ensconced in the Chinese financial system. There are opportunities for that. The question is whether with geopolitics and with all the other problems, Beijing is going to be welcoming with open arms all these American institutions. I think they want them for certain things. I think they want their know-how. Then the question is, will they keep them around? It's just a much dicier situation than it was a bunch of years ago when all these firms who had put time and money into the Chinese economy said, look, it's just a matter of years before we get this back. That may not be the case.